Cash or accrual? For most small business owners, that question makes eyes glaze over. It sounds like accounting jargon, something only CPAs or IRS agents care about. But here's the truth. The difference between cash and accrual isn't complicated. It's just about when you record income and expenses. That's it. One method says, record it when the money moves. The other says, record it when the action happens, even if the money hasn't moved yet. That small shift in timing changes how your books look, how your taxes are reported, and how you understand your business. If you're an Etsy seller, food vendor, or tradesperson, you've probably asked yourself, do I really need to care about this? The short answer, yes, but not for the reason you think. For peace of mind, when you understand which method you're using, you stop second-guessing your numbers. For compliance, the IRS requires you to stick with one method consistently. Flip-flopping creates confusion. And for clarity, knowing the difference helps you explain your books to a tax pro, a banker, or even just yourself. And here's the good news. Most small businesses don't need to overthink this. The IRS lets businesses under $25 million in annual revenue use the cash method. That's nearly every Etsy seller, side hustle, or tradesperson listening right now. So no, you don't need to stress about accrual unless you hit a size where it matters. But understanding the difference, that's power. Let's make this real. As an Etsy seller, you make a sale on December 30th, but Etsy doesn't deposit the money into your account until January 2nd. On cash basis, you record it in January when the cash hits. On accrual basis, you record it in December when the sale happened. As a food vendor, you buy $500 of ingredients on credit in May, but don't pay the bill until June. On cash basis, you record the expense in June when you pay. On accrual basis, you record it in May when you incurred it. And as a tradesperson, you finish a $2,000 job in September but don't get paid until October. On cash basis, you record income in October. On accrual basis, you record it in September. See? Same transactions, different timing. That's the whole difference. Cash basis feels natural. Money in, money out. It matches your bank account, which is how most of us think about money anyway. That's why it's the default choice for small shops. But here's the twist. Accrual can sometimes give a clearer picture. It matches income with expenses so you see the true profitability of a period, even if cash hasn't changed hands yet. That's why larger businesses use it and why lenders often prefer it. So here's what we'll cover today. Cash basis in plain English. How it works, why it's simple, and how to use it correctly. Accrual basis in plain English. What makes it different, when it helps, and examples you'll understand. Why cash usually works for small shops, the IRS rules and practical benefits. When accrual might be required, only for education, not advice, and a practical takeaway, how to know which method fits your business right now. By the end, you won't just nod when someone mentions cash versus accrual. You'll understand it well enough to explain it to someone else, in plain English. Because bookkeeping isn't about jargon, it's about clarity, and once you know the difference, you can stop stressing and get back to running your business. Let's start with the simpler of the two methods, cash basis accounting. If you only take away one thing from this section, let it be this. Cash basis means you record money when it actually moves. Income gets recorded when you receive it, expenses get recorded when you pay them. That's it. No waiting, no guessing, no adjusting. Cash moves, you write it down. For most small business owners, cash basis feels natural because it matches your day-to-day life. Think about your personal finances. You count your paycheck when it hits your account, not when your employer promises it. You track your rent when you actually pay it, not when you sign the lease. Cash basis bookkeeping works the same way for your business. Let's look at a few examples. As an Etsy seller, a customer places an order on March 30th. Etsy doesn't deposit the funds until April 2nd. On cash basis, you record the sale in April when the money hits your account. As a food vendor, you stock up on $500 of ingredients at the local restaurant supply company on credit in June, but don't pay the bill until July. On cash basis, you record the $500 expense in July when you pay the bill. And as a tradesperson, you complete a $1,000 project in August, but don't get paid until September. On cash basis, you record the $1,000 income in September when the cash arrives. Notice the pattern? Cash basis always waits for the money to move. Cash basis has 3 big advantages. 1, it's easy to understand. No need for complicated adjustments. 2. It matches your bank account. What you see in your account is what's in your books. And 3. It's IRS approved. As long as your business makes under $25 million a year, the IRS allows you to use cash basis. That covers 99% of small shops, Etsy sellers, and tradespeople. For a one-person or small team business, simplicity is often the biggest win. Here's what the cash basis looks like in your books. Income. Log sales when money is deposited into your account, cash, check, credit card, or Etsy payout. And expenses. Log cost when you actually pay them, not when you receive a bill. That means no accounts receivable, waiting for money owed, and no accounts payable, tracking unpaid bills. Everything is recorded at the point of payment. Let's walk through 1 month for a small Etsy seller on cash basis. On March 1st, they buy $200 in fabric with their debit card. They record $200 in expenses on March 1st. On March 15th, they sell a quilt for $300, but Etsy doesn't pay until March 18th. Record $300 income on March 18th. March 20th, buy $50 in shipping supplies. Record $50 expense on March 20th. March 30th, sell $400 in products. Etsy pays April 2nd. Record $400 income in April. At the end of March, your P&L shows income of $300, expenses of $250, and a net profit of $50. The April $400 sale won't appear until April's books. So what are some of the pros of cash basis accounting? Clarity. You can literally match your books to your bank account. Speed. No complicated adjustments for unpaid bills or uncollected sales. IRS friendly. It's easy to explain during an audit. Receipts and bank records line up perfectly. And perfect for cash flow management. You see exactly what you have available. Now there are some cons of the cash basis method as well. Timing gaps. If you do work in 1 month but don't get paid until the next, your books don't reflect that activity until later. They're not always accurate for growth decisions. Income and expenses may look lumpy depending on payment timing. And limited insight. You can't see outstanding invoices or unpaid bills in your books. You'll need a separate system if that matters. And when does cash basis work best? Cash basis works beautifully if you run a small shop, Etsy store, food stand, or solo trade business. Have relatively simple transactions, and care most about matching your books to your actual cash flow. In short, if you're under $25 million in revenue and not required to use accrual, cash basis is usually all you need. Now here's an IRS angle. The IRS allows most small businesses to use cash basis if annual gross receipts are under $25 million. Once you pick a method, cash or accrual, you should stick with it consistently. If you ever need to switch, you'll file a form with the IRS. So yes, the IRS does care which method you use, but they also make it easy for small businesses to stick with cash. For you, the benefit of cash basis is peace of mind. When you look at your books, the numbers reflect your reality. If your P&L says you earned $3,000 last month, you actually saw $3,000 hit your account. If your P&L says you spent $800, you actually saw $800 leave your account. That's why cash basis feels so intuitive. So to wrap up this section, cash basis means you record income when cash comes in and expenses when cash goes out. It's simple, it's an IRS approved method for almost every small business, and it matches your bank account. For most Etsy sellers, food vendors, and tradespeople, cash basis is not only enough, it's the best choice. Up next, we'll look at the other method, accrual basis. It's more complex, but understanding how it works will help you appreciate why cash basis is often the best fit for small shops. Now that we've covered cash basis, the record it when the money moves method, let's look at the other side of the coin, accrual basis accounting. Accrual sounds intimidating, but in plain English, it just means this. You record income when it's earned and expenses when they're incurred, even if no cash has changed hands yet. In other words, accrual focuses on when the business activity happens, not when the money actually hits or leaves your accounts. The core idea: income, record it when you earn it. For example, you deliver a product or finish a job. And expenses, record them when you incur them. For example, you receive a bill even if you haven't paid it yet. So instead of waiting for money to move, you capture the financial reality as it happens. So why do businesses use accrual? Accrual is the standard for larger businesses because it gives a clearer picture of profitability. By matching income and expenses in the same period, it shows whether your operations actually made money, independent of cash flow timing. Cash basis tells you what's in your wallet, accrual tells you how healthy the business is on paper. Let's walk through a few examples. As an Etsy seller, on December 30th, you sell a handmade item for $200. Etsy won't deposit the funds until January 2nd. Cash basis, you record $200 in January. Under the accrual basis, you record $200 in December because that's when the sale happened. As a food vendor, on May 20th, you order $600 in ingredients on credit. You don't pay until June 5th. Under the cash basis, you record the $600 expense in June. Under the accrual basis, you record the $600 expense in May when you receive the ingredients. And as a tradesperson, on September 15th, you complete a $5,000 project, but the client doesn't pay until October 10th. Under the cash basis, record $5,000 in October. Under accrual basis, record $5,000 in September when you finish the work. Accrual lines up the expense or income with the activity, not the cash. Now with accrual, you'll see two new terms appear. 1. Accounts receivable, or AR. Money customers owe you. You've earned it, but haven't received it yet. And 2. Accounts payable, AP. Money you owe to vendors, you've incurred the expense, but you haven't paid it yet. These accounts help track the gap between action and cash. So what are some pros of the accrual method? 1. Accuracy of profitability. Matches revenue and expenses in the same period, so you see the true financial picture. 2. Better for growth decisions. Lets you evaluate whether jobs or products are profitable, independent of cash flow quirks. And 3. Required for many larger businesses. Public companies and businesses over $25 million in revenue must use accrual. Now there are some cons to the accrual method as well. Number 1, complexity. It requires more bookkeeping detail, tracking receivables, payables, and adjusting entries. 2, cash flow blind spots. You may show a profit, but still be cash poor if customers haven't paid yet. And 3, it's less intuitive. Your P&L may not match your bank account, which can confuse new business owners. Now, sometimes accrual paints a clearer picture. For example, you're a tradesperson finishing jobs in December but not getting paid until January. On cash basis, December looks terrible. You have no income and high expenses. On accrual, December shows strong revenue and the expenses that went into it. Or you're a food vendor, buying ingredients in bulk one month for events happening the next. Accrual matches costs to the events, showing profitability more accurately. So why do most small shops not use it? The catch? For most Etsy sellers, food vendors, or tradespeople, accrual is overkill. You don't need to track AR or AP if your customers usually pay at the point of sale. Etsy, craft fairs, food events. You don't carry large unpaid vendor bills, and your revenue is well under $25 million. Cash basis already aligns with your cash flow reality. Now, the IRS does require accrual for C corporations in most cases, businesses over $25 million in gross receipts, and certain inventory-heavy businesses. But for nearly all small shops and side hustles, cash is acceptable and easier. So let's wrap up this section. Cash basis equals record when the cash moves, and accrual basis equals record when the activity happens. Accrual gives a clearer profitability picture, but it's more complex and less intuitive. It's the method of choice for larger businesses, but not necessary for most small shops. Up next, we'll talk about why cash usually works for small businesses and why sticking with it can save you time, money, and stress. At this point, you understand the two bookkeeping methods: cash basis, record money when it moves, and accrual basis, record money when it's earned or incurred even if cash hasn't moved. Now let's get practical. If you're an Etsy seller, food vendor, or tradesperson, which one should you use? For nearly all small businesses like yours, the answer is cash basis. Let's talk about why. Reason number 1, the IRS says it's okay. The IRS allows businesses with average annual gross receipts under $25 million to use the cash method. That's nearly every Etsy shop, food stand, or solo tradesperson in existence. Unless you're scaling into a massive operation, you don't have to worry about accrual requirements. Cash is not a shortcut, it's an IRS-approved method. Reason number 2, it's simple and intuitive. Cash basis is straightforward. You see money hit your bank account, you record income. You pay a bill, you record an expense. That matches how you already think about money in your personal life. There's no mental gymnastics about, did I earn it yet, or do I owe it but haven't been paid? Simplicity is power when you're wearing 10 hats in your business. Reason number 3, it matches cash flow reality. Here's the biggest benefit. Cash basis shows you the money you actually have to work with. When you look at your books, the income is cash you've already received. The expenses are cash you've already paid. That makes it crystal clear how much money is available. Accrual might tell you that you earned $5,000 this month, but if none of your customers have paid yet, you can't spend that money. Cash basis avoids that disconnect. Reason number 4, it reduces stress. Running a small shop is stressful enough without complicated bookkeeping. With cash basis, your P&L matches your bank account. Reconciling is easier. There are fewer adjustments to make at year end. You don't have to be an accountant to understand your own books. Reason number 5, it's easier to stay consistent. The IRS doesn't like flip-flopping between methods. Once you choose cash basis, you stick with it. Because it's simple, you're more likely to keep up with it month after month. And that's the real win, consistency. Clean, updated books matter more than fancy accrual adjustments you'll never maintain. Let's look at some real-life examples. As an Etsy seller, you sell $3,000 worth of products in March. Etsy deposits $2,800 in March and the remaining $200 in April. On cash basis, you record $2,800 in March, $200 in April. That matches your bank deposits, which is exactly what you see. As a food vendor, you buy $400 in ingredients for a weekend event. You pay cash at Restaurant Depot. On cash basis, you record $400 immediately. No waiting, no confusion, it matches your out-of-pocket spend. And as a tradesperson, you finish a $5,000 job in June but don't get paid until July. On cash basis, you record $5,000 in July. That matches your bank account, helping you manage cash flow. For all three, cash basis keeps books aligned with reality. And there are some times when cash basis is especially helpful. If you have a seasonal business, if you make most sales during the holidays, cash basis ensures your books reflect actual cash flow so you can manage lean months better. Side hustles. If you're balancing your business with a day job, the simplicity of cash basis prevents overwhelm. And low volume operations. If you have fewer than 1 to 200 transactions a month, accrual adds complexity without much benefit. And the myth of more professional. Some business owners feel pressured to switch to accrual because they think it looks more professional. But professionalism doesn't come from the method, it comes from keeping your books clean and consistent. A messy accrual system is worse than a clean cash basis system. Banks and tax pros would rather see clean records and cash basis than sloppy accrual numbers. Now there are some times when cash might let you down. Cash basis isn't perfect. Here are 2 scenarios where it can be misleading. 1. Big unpaid bills. If you stock up on $5,000 of materials in December but don't pay until January, your December books won't show the expense. On paper, December looks more profitable than reality. And 2. Jobs that straddle months. If you finish work in December but don't get paid until January, December looks worse than it really was. These timing quirks are why larger businesses switch to accrual. But for most small shops, the simplicity outweighs the occasional distortion. So let's wrap up this section. Here's the bottom line. Cash basis is IRS approved for nearly all small businesses. It's simple, intuitive, and matches your bank account. It reduces stress and makes consistency more likely. For Etsy sellers, food vendors, and tradespeople, cash basis is not only enough, it's usually the best choice. Next, we'll cover the exceptions, the situations where accrual might be required even for smaller businesses. So far, we've made the case that cash basis is usually the right fit for small shops, Etsy sellers, and solopreneurs. And that's true. But there are a few situations where the IRS or outside parties may require you to use accrual basis. Let's break those down. And remember, this is education only. This isn't tax or legal advice. Always confirm with your tax professional before making changes. The IRS has a clear rule. If your average annual gross receipts are over $25 million, you must use accrual. That number is adjusted every few years, but for most small businesses, it's not a concern. Still, if you're on a rapid growth path, it's something to be aware of. Most C corporations are required to use accrual basis unless they qualify for the small business exemption under that same $25 million rule. Partnerships with C corporation partners may also fall into this requirement. If you're running a corporation or partnership that involves one, accrual may be mandatory. If your business involves significant inventory, the IRS often requires accrual. Why? Because accrual better matches income and expenses when inventory is involved. For example, you buy $10,000 worth of raw materials in March. You sell finished goods made from those materials in June. On cash basis, March would look terrible, all expense, no income. And June would look fantastic, all income, no expense. On accrual, the cost of goods sold, COGS, is matched to the income from those sales. That's why inventory-heavy businesses lean toward accrual. Even if the IRS doesn't, sometimes banks or investors will require accrual financials. Why? Because accrual gives them a clearer picture of your profitability and obligations. They don't want to see how much cash you have, they want to see what's owed and what's coming. For example, a lender may want to know your accounts receivable balance before approving a loan. An investor may want accrual statements to evaluate long-term profitability. If your business works on contracts that span months or even years, accrual may give a truer picture of your income and expenses. For instance, you sign a $50,000 contract to complete work over 6 months. On cash basis, you'd only record income when payments arrive, which may be uneven. On accrual, you'd record income as you earn it across the project timeline, smoothing out the picture. This isn't required for all small businesses, but it's a reason some switch voluntarily. Let's pause here. None of this means you should rush to accrual. For the majority of small shops, cash basis is simpler and sufficient. These are just the exceptions where accrual might be required or requested. So to recap, accrual may be required if your business earns over $25 million annually, you operate as a C corporation or certain partnerships, you're heavily inventory-based, lenders or investors demand it, you run long-term contract projects where cash distorts reality. For everyone else, cash basis is not only allowed, it's recommended. Next, we'll close this episode with a wrap-up and practical takeaway, so you know exactly how to approach this decision for your own business. We've covered a lot in this episode, but here's the bottom line. Cash versus accrual is just about timing. Cash basis records money when it moves. Accrual basis records money when it's earned or incurred. That's it. 2 methods, same transactions, just a different moment of recording. So here's your key takeaways. Cash basis is simple, intuitive, IRS approved for almost every small shop under $25 million in revenue. It matches your bank account and keeps bookkeeping stress low. Accrual basis is more complex, but it matches income and expenses in the same period. Required for larger businesses, certain corporations, or when lenders and investors demand it. For most small shops, cash basis is not just good enough, it's the best fit. So here's your practical takeaway. Check which method you're using now. If you're not sure, look at your bookkeeping system or ask your tax preparer. If you're under $25 million and not a corporation, you're free to use cash. Don't overcomplicate things. Stick with one method consistently. Don't flip back and forth. That confuses the IRS and creates messy records. If you think you might need accrual, ask a pro, especially if you deal with heavy inventory contracts or outside vendors. For Etsy sellers, food vendors, and tradespeople, here's the simplest advice. Start with cash, keep your books clean, focus on consistency. You'll gain clarity, numbers that make sense. Confidence. You can explain your books to anyone, and calm. No need to overthink or stress about IRS jargon. Cash versus accrual isn't about being professional or advanced. It's about choosing the method that gives you the clearest picture without adding unnecessary stress. For most of you, that's cash. And that's not cutting corners. That's smart bookkeeping. Because at the end of the day, your books are a tool, not a trap. Choose the method that keeps you moving forward with clean books, less stress, and zero fluff.